Weekly stock market update, friends, and from a different location than normal. I thought you might prefer to see that more than me. So let's do that and let's carry on with the market update. We're taking the new approach with a lot of new stocks that I'll be covering. So you're going to like that. Okay. Now, what have we got over here? These are the sectors. And the sectors, as you know, whilst I don't do a top-down approach, you can see which sectors particularly are almost fail-safe at the moment. Utilities, certainly. Almost everything in utilities, some of these we'll cover later, doing well. Almost everything in real estate looks ugly, so I'd stay clear of those. I guess the popular technology ones has quite a mixed bag, so just be careful with tech because you do have some outliers. And if your portfolio looks like this, which it typically will in a year, where you'll have some which might underperform, others which get dragged higher. That's what a typical portfolio looks like. It's not too bad. But of course, what you ideally want, and this rarely happens other than say 2023, is you want it to look more like this, where it's mainly in positive territory. These are the percentage returns. Again, communications doing well. Financials, which we'll see in a second, are undervalued, and that's why they have been doing rather well. Consumer cyclical, mixed bag. Harder to get winners out of that. But energy, which we know is undervalued, also doing well as well. So you want a degree of performance. You want, ideally, all of your stocks in a sector to be up there, not crowded here, and certainly not mixed with negative and positive. If you can help it, if you can. And again, consumer staples, not too bad. And you can also see in here, the large cap companies are some of the winners. They say elephants don't dance. In other words, big companies don't provide the biggest returns, but they do, with the exception of Tesla, which provides big losses. So let's dive deeper into which might look attractive, okay? And as you know, what I do with the markets is I am looking at value growth income across 10,000 companies. So every single one of the ones you would have seen in all those sectors, ticking that they're undervalued, they're growing in revenues and profits, they're producing dividends, good cash return on capital invested. That comes from Goldman Sachs Wealth Management. Good momentum, which isn't guaranteed to continue, but certainly is a good indicator of direction. Sortino and Alpha, that ensures that the market should, if it have dips, not dip too far and not for too long. Can't guarantee it, but that's what it essentially means, right? So let's look at the past week and how things have been. Well, Microsoft's up 2.1%. What about some of the others? What do we get there? Nvidia continues going up. Oracle has come up as well. Apple, Alphabet, Walmart, Danaher. Now, what you should know is the financials are undervalued, energy is undervalued, but it's not been performing well, and these over here are. But valuation is not the only thing that moves stock prices, as we know. Otherwise, Nvidia wouldn't go up, although that's actually quite well valued. It is momentum, it is cash flow, it is growth, of course, which is important as well. So we're going to take a deeper dive into each of those factors. Two, how is the S&P 500 up 11%? Year to date, the UK similar, which is unusual for it to be doing so well. The Nasdaq up 10 and the Dow, you can see over there. What you can also see is the high degree of correlation between indices. You can see when they all rise, and some rise more than others. They're almost like a leverage version of each other. So if you take the base as the Dow there, the others are just multiple leverages of the other. In other words, they have an increased beta, not an alpha. They're not necessarily giving you an edge. They're giving you not asymmetric upside compared to downside, but actually symmetric upside and downside. So as long as they're all rising, you're doing fine. Anyway, I'll get more into some of that in other webinars, in other calls. NASDAQ in the last 12 months. So think about it. This is from May to May, okay? From May to May, the NASDAQ is up nearly 40%. So you didn't have to think, oh, I missed the boat last year, because I'm looking at January to January or February to February and so on. There are many a boat. And in fact, this year started initially quite strong and then had this wobble and then has rebounded to all-time highs again. Okay. And that's a phenomenal set of returns. My job is to get people to be able to take advantage of the opportunity when the opportunity arises. They say preparation plus opportunity equals success. My job is not to be able to find rising stocks when the whole markets are falling, because that's very difficult. We might have to go into cash in some of those periods, or hold more cash rather than all cash. You'd go from a scale of 0 to 100%. 100% cash was 2022. 0 is, well, a lot of 2023. Not all, but a lot. Okay, so where are we on the FTSE 350 over the past month? These are the best performers there for the FTSE 350. You can look at those yourself. What about the S&P? Now, this is where it gets very interesting for me. That is still, the monthly's on an upward trend. That there was what you might call a baby bear market. What's a baby bear? That fall here was a baby bear, that was a mama bear, and that was a daddy bear. Now, we want a Goldilocks stock market all the time, obviously, if we can get it. Sadly, we don't. We get only 3 types of falls in stocks and indices and all kinds of instruments. And if you know what they are and how to spot them, then, well, like Goldilocks, you will stay out of trouble most of the time. So, Daddy Bear, simply put, monthly MACD falls below its moving average from a high overbought position at a steep gradient. Mama Bear, and that's when you want to be largely in cash. Mama Bear is this one where you might hold up to 30-40% cash depending on your risk appetite, but the rest of your stocks you may well hold. That's where the weekly's falling and the monthly's falling, but the monthly hasn't fallen, the MACD, but it hasn't fallen below its own moving average. Okay, that's Mama Bear. Baby Bear is the weekly's falling. So the weekly falling is what they all have in common, which is just a reflection of all of their prices falling. The difference is that with the Baby Bear, where you might take some money off the table if you've had huge gains, as I did, but normally you wouldn't. Normally you just sit it through, is where the monthly's rising, but the weekly's the one that's falling, and that then does that. Now, Baby Bear could become a Mummy Bear. We don't know. Could do a bit of a transformation. Mummy Bear become Daddy Bear as well. We won't necessarily know, and that's the risk you take, which is why you might take some money off the table, take some profits if you're not sure which way things are going to go. If you're more risk-loving, you'd say, well, I'm not going to take any cash. I'm just going to wait until I know for sure that it's a Daddy Bear. Okay? Simple as that. Very simple. Now, FTSE 100, where are we at the moment? Looking somewhat attractive because the gradient is steep. However, as I've always said, my worry has always been that can it last and pull through? Well, at the moment it looks like it, which has surprised me. But like I said, been saying for a while, it's looking upward, but I'm surprised that it's not exhausted and fallen back, which it tends often to do. More interesting for me, because of the scale of returns, as you saw from the indices earlier, is the NASDAQ. Now, the NASDAQ, similar to previous periods, always, whenever you buy anything, whether it's an index or a stock, look back at a previous period where it was rising and look at the worst drawdown. Drawdown means the biggest drop from peak to trough, okay, and duration. So remember this. Drawdown danger equals depth times duration. So peak to trough depth and duration for which it fell. Okay, so look at both of those and assume as soon as you buy something, that is going to repeat itself again. Exactly the same drawdown depth and duration. Now, as you know, I do these market updates in 2 parts just because of social media duration limits for posting videos. So I'll do part 2. I'll let you know when that starts. Okay, so leverage shares, Microsoft. I sold out of these because I had them since January of 2022. Leverage is high risk. Do not do it. Do not do it. This is not individual financial advice, but don't do it because it's too much high risk for most people. Look at that drawdown depth and duration and look at the amount you can lose. If Microsoft drops 10%, you lose 20%. If it drops 20%, you lose 40% of your money. If you lose 40% of your money, you've almost got to make 100% return in order to get back to it even. Do you see why you shouldn't do it? Yes, you should not do it. Okay, so that's Microsoft over there. I'm going to come back to the 2 times over, which I still own in Amazon in part 2 of the weekly stock market update. So hang on for that.